All right. Good morning, everyone. It's Monday, September 16th. Ed is out in Venice, Italy, or somewhere in Italy. I'm here in Venice, California. So I'll be manning the ship today. A very fun week ahead, a lot to discuss. I'm sure you're all enjoying the 25 basis point versus 50 basis point debate. It's kind of incessant and mind-numbing at this point. Nonetheless, we're going to go through it a bit on like what we think should happen, where we think Fed policy should go, but also where it's likely to head and what the potential implications of both of those two passive policy are. Overarchingly, is 25 versus 50 basis points a huge deal for the economy? Not necessarily, but it's also going to be wrapped in the context of the updated summary of economic projections. So the last quarterly projections were from June, kind of stale. And then they'll give us what we should expect for November and December, because we'll get a 2024 year-end projection for not only the Fed funds rate, but also unemployment, GDP, and the PCED. So we'll get that for the next couple of years as well. Other than that, the week ahead, we have retail sales, industrial production. Again, we're still expecting stronger than expected economic data. Our earned income proxy for private wages and salaries rose 0.8% month over month last month in nominal terms, with 0.2 or less than 0.2% month over month CPI. We should get a pretty strong increase in real incomes, and we think that'll propel retail sales, particularly after July was fairly weak due to the weather. And with that said, let's get into it and we'll talk about the Fed. Let me share my screen here. All right, you should all be able to see that. So in the history of easing cycles, the Fed typically cuts by 50 basis points or more. That's because there's a financial crisis that is leading to or is causing a credit crunch, and eventually, leads to a recession. There's a historical precedent for 25 basis points, though. I think the best analog for the current economy and what the Fed's current easing cycle should look like is 1995. So that's right here. You had a quarter point cut, followed by a few more. I think we had 75 basis points of cuts in 95. There were some more in 98, though that was due to financial crisis. So you had a big 50 basis point cut due to LTCM, and like some money market, treasury market dysfunctioning, but you didn't have this huge easing cycle. And that's consistent with a soft landing. And 1995 is the soft landing the Fed is kind of trying to emulate. 1995 ended up in the dot-com bubble, but there was 4 to 5 years of pretty solid gains leading up to that. And this chart, we've showed it plenty of times before. It's just showing it's kind of our credit crisis cycle theory. It's not like the slow unwind of the labor market and the long and variable lags that precipitate a recession. It's the Fed raises rates. The inverted yield curve correctly predicts that there is some sort of credit crisis or financial crisis that's going to happen, and then the Fed cuts swiftly. We did have a regional banking crisis that was, brought on by extreme duration risk in the banking sector, as well as the liabilities of several of those regional banks were highly concentrated in the VC sector, tech, the startup scene. Again, those are all like the longest duration assets. It's kind of what you'd expect to be under pressure in a tightening campaign. But the Fed and the FDIC and Treasury mopped that up pretty quickly. So we've been the last 2 years crisis free, quote unquote, at least as financial markets are concerned. So we don't really think there's a huge impetus for these cuts. The unemployment rate is slowly rising, and we're going to get through why it's rising and potentially how cuts could ease that situation or prevent it from deteriorating. But the whole unemployment begets unemployment thing because of long and variable lags it's more of a statistical like thing that happened in history rather than some sort of economic fact. It doesn't just happen on its own. There's usually an exogenous shock. So yeah, this was on Friday, market pricing. Actually, now it's not even a coin flip. Markets are a little more towards 2-to-1 odds of a 50 basis point cut versus 25 basis points. There's been a slew of stories in the media. I wouldn't rest too heavily on this like 65% or whatever it is chance of a 50 basis point cut. These odds can swing pretty heavily though. Usually you get a little more certainty in the days ahead of an FOMC meeting. But we had Nick Timmeros at the Journal, my former colleague, wrote a story just basically saying, should we go 25 or 50 basis points at the September meeting? What are the arguments for both? This morning, Bill Dudley, the former New York Fed president, wrote a story or an opinion column in Bloomberg arguing for 50 basis points. It's kind of interesting that in May or June, he wrote an op-ed saying the Fed doesn't need to do anything here. You know, the neutral rate of interest has risen and we're good standing pat. Something changed for Bill. We might think it has to do with politics, but nonetheless, he was arguing for that. Greg Ip in the Journal also arguing for a 50 basis point cut, not in an opinion article. It's just his column. So the voices are growing louder. You had Democratic senators this morning arguing for 75 basis point cuts. So this is where we're at. We still think the Fed is going to go 25 basis points, but let's just discuss what the possible impacts are of both. And this is another reason why 50 basis points or so is kind of expected, right? People want or think the Fed needs to get to neutral as quickly as possible. We saw a lot of rate cuts in past easing cycles. The average is around 420 basis points from peak to trough on the Fed funds rate. So if we're going to get there anyway, right, and we're going to cut the Fed funds rate from 5.33% to 2.5% or 3% or 3.5%, like why not go as quickly as possible and shore up the economy before there's any potential exacerbated stress in the labor market? So that's the argument, right? What could a 50 basis point cut and then broadly a bigger pace of easing do for the labor market? For one, you'd get a lot of that stress in commercial real estate and even residential real estate coming off. We've been in a manufacturing and construction recession for the past couple of years. The only part of manufacturing or construction that's looked really good has been, on one hand, defense, which is kind of inelastic relative to interest rates. There's not a lot of sensitivity there. The government's the main buyer, as well as manufacturing structures. So semiconductor facilities or fabs are getting constructed kind of en masse. And the reason for that is fiscal stimulus and the fiscal packages passed by the Biden administration. But absent that, it's been pretty weak in the manufacturing sector. So if we get rate cuts, a lot of these capital intensive sectors will, should benefit. We'll get more production. We should get more job openings in these sectors as well. We've actually had a lot of construction hiring, and a lot of people have been worried that it's not consistent with the number of housing starts that are going on, the number of housing permits, both of which have been falling. So rate cuts should help prevent that from coming off and prevent layoffs in the construction sector. And here you can see construction supplies just weak in IP. So rate cuts should help boost industrial production. And then there's kind of a knock-on effect, right? Like people are buying more homes or people are moving. You finally get sellers who see prevailing mortgage rates aren't drastically higher than whatever they refinanced at or locked in during the pandemic. They're willing to move. You'd get increased retail sales for large goods, appliances, furniture. Durable goods prices have been deflating I think it was 4.2% year over year. Last month, good CPI has been down substantially. A big chunk of that is due to China's dumping cheap exports onto global markets and depressing global goods prices, but also demand has been pretty lame. We had the huge spike in demand during the pandemic when services were essentially shut off. We had a wave. We had a wave of income and rising asset values. Plenty of people moved, bought a new house. So we're seeing the start of that buying and demand come back, and that should reaccelerate. Should the Fed cut rates, that should also help for hiring and job openings in some of those retailing sectors. Where else would Fed cuts help? One of the huge stories for the past couple of years, and what a lot of the diehard hardlanders point to, is sentiment has been severely depressed. Like other than the consumer confidence and the conference board, pretty much every indicator looks pretty rough. A huge contributor to that is cumulative inflation. When prices rise 33% over just a few years, people are going to be pretty pissed. And we have noted that real wages, particularly for lower wage or production and non-supervisory workers, real wages have been rising. So the nominal wage increases are beating inflation. But that 33% rise in prices isn't equal. The cost of essentials have risen much more than the cost of discretionary items. You have a 40 to 50% increase for a lot of the basic kind of needs in your day-to-day life. That's going to hit the lower income sectors of the economy much more. So people are pretty upset about that. You have record housing and affordability. Everyone wants to buy a house. It's kind of the American dream, or the bedrock of our economy is real estate ownership. If you can't afford a house, then you're also not going to be thrilled. Or if your kids, are kind of struggling to afford a house. So we'd expect this to improve with a larger pace of easing, I suppose. Small business optimism, it ticked up 2 months ago. Again, pretty depressed. This isn't exactly following through with weak hiring demand. Small businesses still cite, they can't find qualified applicants for their jobs, but financing conditions are tighter. The prime rate is much higher, and there's a lot of uncertainty, right? Like with rates this high, and you're expecting some easing. You're not sure when or how far inflation is going to fall, or when it'll reach 2%. That leads to a lot of uncertainty with business planning. Small businesses are not sure what to do. Just because they're hiring doesn't mean I think one of the interesting things is not every worker is equal in terms of their skill set, right? So the beverage curve, or the ratio of vacancies to the unemployment rate, got really out of whack as we were coming out of the pandemic. And part of that is because we had really high unemployment, but we also had a lot of job openings. And the crux of that is there's a mismatch between the skills of the labor on offer, labor supply, and then the skills that employers needed via labor demand. So what we're actually seeing in the labor market, I'll get to this in a second. I want to go to this chart real quick. So what we're seeing in the labor market is younger workers, so teens, earlier than college grad, as well as workers without high school degrees, or less educated workers, are becoming unemployed much quicker than the other cohorts of the labor market. And let's take out new entrants, immigrants, people encouraged to come back and participate in the labor market, that are causing the rise in unemployment. If you think about this group of workers who are young or uneducated or less educated, first of all, they compete with immigrant labor quite closely. And you see that unemployment, particularly in metro areas with a lot of immigration, is much higher than in other areas in the rest of the country. Border states, blue states, metropolitan areas, that's just where it's concentrated. And it makes sense. That's where you're going to compete with. But if we stimulate the economy, if the Fed starts easing rapidly, the demand for labor still might be skilled labor, like a skilled labor force, or they need skilled workers that these people haven't had the chance to retrain or get those skills, or they're not educated enough for the job openings that arise. That would still lead to a mismatch where you're not really preventing unemployment from rising, whereas you're just increasing job openings and then potentially leading to a wage price spiral. So let's go back. Layoffs have remained pretty muted. Overarchingly, the labor market's been a story of cooling hiring from a record a record amount of heat or an incredibly tight labor market, and the hiring environment's cooled, but layoffs have been muted. The worry for some is that layoffs will pick up now that hiring has come off. Fed cuts would solve that. But I don't necessarily think that ratio or that relationship would hold up in this environment. But nonetheless, that's what the Fed is trying to prevent. And this is going back to what I was saying. Goods prices have been deflating largely due to China. If you think about it, though, like where is inflation? The CPI, well, core CPI is still above 3%, but CPI on a headline basis, 2.5% year over year. The PCED tends to be a little bit below CPI. So let's say the PCED is between 2.3 and 2.5% on a year over year basis. How did we get here? Goods prices are deflating. That should continue based on where China is at. We don't think their recession is over. We don't think it's necessarily bottoming. They're really stuck between a rock and a hard place. And as of right now, their kind of cures for their domestic demand ailments seem non-existent or simply not powerful enough. The CCP doesn't really know what to do to stimulate consumer demand, or they're not willing to put more purchasing power into the hands of their consumers. So this should continue. Shelter prices, meanwhile, have been very sticky, but perhaps we get an influx of housing demand rather than enough supply to offset it, and housing prices remain sticky high. Rent prices might not continue disinflating. So we have basically a pretty sticky, and also oil prices have been falling pretty drastically. So the price of gas, which is like the biggest inflation measure that everyone sees every single day on their way to work, has been falling pretty substantially. So we have falling gas prices and we have deflating goods prices, but core or super core inflation is still pretty hot. If you take CPI services and you strip out shelter or you strip out food and energy, we're still above 4% on a year over year basis. And that's kind of the core underlying inflation that even the Fed and Jerome Powell were pointing to last year. So if this is the measure of underlying inflation, I'm not exactly seeing how it's tamed. So we're kind of risking another resurgence or at least sticky inflation above target. Let's say the Fed cuts 75 to 100 basis points this year. We get into the first or second quarter of next year and goods prices rebound or oil rebounds from $70 a barrel to $90 a barrel. And then CPI is back towards 3.5%, 4%. What does the Fed do in that situation? It would look like they cut too early. Again, that doesn't necessarily have to happen, but they're definitely upping the risk of inflation returning or inflation not reaching the Fed's target or simply just being higher than the Fed's target. And we'll get more of those stories from the Jason Furmans of the world saying maybe the Fed doesn't need a 2% target and we can live with 3%. I don't think we should live with 3%, especially after experiencing 30 to 40% cumulative inflation over just the past few years. Here's unemployment rate by education. You can see less than a high school degree, increasing pretty rapidly, while the rest of the labor force seems on decent footing. And here is small business hiring. Again, you can see no qualified applicants for job openings. So there's definitely a labor shortage. And in our roaring 2020 scenario, you offset that skilled labor shortage with capital intensive investments, IP, software, R&D. And then you get productivity gains that decrease your need for that labor. We might already be seeing some of those productivity gains, especially in the tech sector, decrease job openings and hirings, and then just letting employees fall off via natural attrition. But that doesn't happen so rapidly. And even if AI comes in and saves the day and we get a ton of productivity gains and companies don't need as much labor, should the Fed really be operating monetary policy based on that? I'm not sure they, or really anyone, has a grip on how quickly or how impactful that'll be over the next 6 to 12 months. So, it's what we foresee, but I'm not sure that's how the Fed should conduct monetary policy. And yeah, this chart is pretty annoying in general, but it seems to be a favorite, especially for the doves on the FOMC. It's the real Fed funds rate. So you take the nominal rate, 5.3% and change, and then adjust that by the year over year change in CPI, and it rises as inflation falls. Is this a metric for how anyone actually finances themselves, any household or business? No, no one really makes decisions based on that. Not a ton of borrowing in this economy is based on overnight rates. You might get like middle market lending that's SOFR plus whatever, but by and large, there's also like when you lever up in the short term markets that impacts your borrowing rates. But by and large, people borrow based on long term interest rates. The 10-year Treasury is at 3.6, 3.7%. That's why financing conditions aren't all that tight, and they're definitely not getting tighter just because this real Fed funds rate is rising. If you think about like empirically, maybe that makes sense to you, but you're like, I'm not so sure. Empirically, real GDP has grown 5.5% over the past couple of years to a record high. So where is the restrictiveness of interest rates? It shows up in rolling recessions in housing and manufacturing, but overarchingly, this economy is less rate sensitive than it used to be and can handle rates here. The Fed wants to cut 25 basis points to shore up a couple segments of the economy and kind of help with job openings. Okay, they want to cut a few more times. Okay, that's kind of what we did in 1995. This rapid interest rate easing cycle below 3% in just 12 months, just to get to this kind of neutral rate, which is non-existent. It's a guess, it's a metric, and that's what Jerome Powell has said repeatedly, as he believes that as well. It doesn't really seem like prudent policy, given there's still plenty of inflation risk left. We haven't solved inflation. We're not dealing with 1.8% core CPI and saying, all right, what do we do from here? But as this number goes higher, that's what several Fed officials will be looking at. Now, this is interesting. We've been talking about the yen carry trade unwind as a source of risk in markets. It impacted last month. It helped weigh on equities as the yen strengthens. Everyone who financed their U.S. tech purchases, or even they just bought Japanese stocks via cheap borrowing in the yen or via for Japanese overnight rates, had to sell their tech positions in the US, go buy back their yen to meet margin calls or exit the positions or decrease their leverage. And so you had a really strong inverse correlation. The yen would rise, the NASDAQ would fall. That actually came off last week. So the yen continued to strengthen. The BOJ looks poised for some sort of hawkish orientation. I'm actually writing about this for tomorrow's morning briefing. But the NASDAQ still rose. It was one of the best weeks for the stock market in a long time. So the yen carry trade is not gone. Like the BOJ has the cheapest interest rates globally by far, and investing in the US will continue to provide a pickup, to provide carry. But it's the extreme volatility by over-levered investors having to meet margin calls, close their positions. That's what causes carry trades to like unwind drastically. So we know some of our competitors have been saying, there could be round 3, right? We don't really think there's a huge potential for that, barring something unforeseen. But again, if they cut by 50 basis points this week and the BOJ raises, their meeting is Thursday and Friday, and the BOJ raises, maybe we do get a little more pressure. But that correlation did come off last week, which was encouraging if you're worried about a further unwind. And I think the Fed is apolitical, right? But they certainly know and consider what the outcomes of political elections are, of the fiscal deficit, of Treasury issuance. The Treasury and Fed work very closely together to issue debt. Yellen and Powell they speak frequently. Janet Yellen has a very unique insight into how the Fed works as being a lifelong Fed person and also a former Fed chair. But if we get a sweep by either party, the policies being proposed by both Kamala Harris and Donald Trump are inflationary unbalance. They require more deficit spending, whether it's, cutting taxes drastically, you have to deficit spend to offset that. Even if you do cut spending by some measures, if you increase federal spending and you're not and even if you're raising taxes, you're still going to widen the deficit. So you get a sweeping end of party, you're going to get more debt issuance, you're going to get more fiscal spend, and that's inflationary by and large. And sure, China's recession can offset some of that. Demand for our debt helps, but running the current fiscal deficit that we are, with no recession materializing and still no major hot war that the US is involved in, sets us up with more upside inflation risk. So it's something to consider. Maybe the Fed will start talking about it in 2 months, but maybe not at this meeting. Net interest paid, should the Fed cut rates to reduce the amount of interest the Treasury needs to pay and thus reduce the deficit? No, that would be fiscal dominance. We don't want the US Treasury dominating what monetary policy does, but this should come off a little bit as the Fed cuts. And that's it. I can keep rambling. If there are any questions, please ask them. But I think one part on this is all this net interest paid by the government is on one hand bad, because we're now spending more servicing our debt than spending on our defense sector, and soon this will be $1 trillion. But also this is stimulus. This is going into people's pockets. The rest of the world owns a lot of our debt, but they bought a lot of our debt when the 10-year was at 2%, and much of this interest is being paid via Treasury bills, which money market funds own, and a lot of retail investors own. There's $1.8 trillion of retail money in money market funds. Personal interest income is around the same amount. So there's been a huge kind of stimulus in the background while we've been doing quantitative tightening. And I think that's important to remember. I will go through some of the things I'm working on for tomorrow if there's no questions. I think the yen is interesting. So the BOJ meets later this week after the Fed. They've somehow committed themselves to hawkishness despite being the easiest central bank in the world for over a decade. We'll see what they do. I think at least they have time to digest what the Fed does on Wednesday before they act. But the yen around 140, and even when it was trading at 145, has done major work against Japanese inflation and probably contained the amount the BOJ needs to hike. Japanese producer prices fell to 2.5% year over year last month, largely due to falling oil and gas prices, as well as a stronger yen. That was the first year over year decline in 8 months. PPI actually fell 0.2% month over month for the first time in 10 months. So you're kind of getting a disinflationary impact just from the stronger yen. And Japanese goods prices are really what's driving overall inflation above 2%. Services have been below 1.5% year over year, but goods prices are up 4%. So as long as the yen strengthens around this level, once the Fed cuts, it kind of supports it, whether the BOJ does or not. We don't think there's too much weakness left in the yen, but it's not a horrible hedge if you're worried about a rapid easing cycle and you don't think, Fed funds futures are the right way to play it. Okay, I'll take a couple questions before we hop off. Let's go with the first one. So Jim Bianco talks a lot about the K-shaped economy. I appreciate Jim's work. He's pretty good. Do you think the fiscal weakness of the low-income consumer is a reasonable reason for the Fed to cut? No, I don't think I think some lower income consumers are obviously hurt by higher prices. And you can see in some of the consumer lenders, Ally Financial, and some of their competitors that low-income consumers have been struggling. I think a lot of that impact is actually inflation that's forcing them to start borrowing more. Overarchingly, though, consumer debt looks okay. Delinquencies are rising from ultra low levels, but not by much. Dollar General is struggling, but maybe Dollar General is a pretty crappy business when Walmart and Target are soaring and doing quite well. Bank of America says they're doing just fine. They're a huge commercial bank. They're saying they see health in their consumer data. real wages are beating inflation. So yeah, I think if I was a struggling company, I too would point to the macro environment and depressed consumer spending as a reason why I'm not doing so well. But clearly there are winners here. And it's not just, I think the ultra wealthy or high net worth households are benefiting certainly more than the lower income cohorts, but it's not a huge K shape where everyone with lower incomes is struggling when in fact their real incomes are starting to rise and beat inflation. Okay, next question. Do I see any impact to small cap stocks in light of the rate cut this week? Yeah, small caps have been pretty depressed due to higher rates. So on one hand, yeah, it's a beaten down segment of the market. Valuations are depressed. On the other hand, small cap earnings have been middling, not new all-time highs. Mid caps are a bit better, but by and large, it's been large caps that have been growing their earnings. I think the rotation or broadening out of the market is going to be more from growth to value and Mag 7 to S&P 493. Some of the sectors that are more rate sensitive or have been struggling in the S&P 500. Small caps are a bad index. It's poorly constructed. You have a lot of regional banks. Nearly half of it is unprofitable. So, I think there's plenty of opportunities for stock picking if that's what you're going to do in the small cap universe. But broad index investing, I'd be wary. Do your homework, I guess. And then last one from Chip, and then we'll hop off. Your thoughts about this jump? Total consumer credit in the U.S. surged by $25 billion. Yeah, that was off. Or July consumer credit actually sank, and then August it rebounded. Some people are saying, "Oh, we can't have a recession because consumers are still borrowing." That never happens in a recession. Consumers stop taking out credit or spending on credit. On the other hand, people are saying this points to a stretched consumer. I don't think I think it's too close to call on either of those. I think it's just normal. We use credit. I know the personal savings rate is quite low. It fell last quarter or last month. And that sparked a lot of worries. But the whole idea of the consumer retrenching, I think, is misplaced. It's been misplaced for 2 years. I think the broader story is record net wealth due to real estate prices and stock prices has combined with plenty of interest income from money market funds and just higher yielding fixed income instruments. So the dissaving or the need to save has been greatly depressed. All the early retirements from baby boomers, they're negative saving, right? They're just spending off no wage and salary income. So I don't think it's a worry. I understand that it's asymptotic to some degree, like personal saving can't fall too much farther, but I think that consumers are spending based on, real income gains and real wage gains rather than just some credit fueled dissaving impulse. And with that, we'll wrap it up. Thank you all for joining. Ed will be back next week. He returns from Italy soon. And look forward to seeing you all soon. Good luck out there. Bye.